Every presentation, I try to have kind of a title, and what comes to mind this quarter is to be determined. There's just so much happening in the world and in the markets right now. A lot of big forces coming coming at us that really will have an impact on markets going forward, but we don't know exactly what impact they'll have. Normally, I try to organize my presentation first by looking back at the markets and where we are, and then trying to give some sense of moving forward. Tonight, I plan to reverse that and to begin with looking forward, and then we'll take a step back and look at where we've been so far year to date. But quite obviously, we have a new president-elect, our 47th president. And it's the first time that we've had a non-sequential president or presidential term since Grover Cleveland. Grover Cleveland was our 22nd and 24th president, and it goes back to his terms of 1885 and his term that started in 1893. No matter where you are politically, there's a shared belief that Trump will usher in sweeping changes. And furthermore, empowered with a mandate to govern with a majority in the Senate, and it looks quite likely to have a majority in the House as well. So the policies will come fast and furious, and there is, both houses of Congress ready to support new laws and legislation and initiatives, many of which are going to have an effect on the markets. So as we think about to be determined, some areas that just come to mind in terms of administration policy that will absolutely affect the markets. There's a growing list of them: tariffs and foreign trade, global trade, and implications potentially for inflationary pressures. That will have a big impact on markets. Immigration policy, and particularly its implications for domestic workforce. Manufacturing and implications on wages and employment. Taxes, clearly, both corporate and personal, will have a significant impact on markets going forward. Antitrust and deregulation will have a significant impact, particularly on certain sectors, as I'll mention in a moment. Healthcare is another area, particularly if there's a role in the administration for Robert Kennedy and all that he hopes to accomplish in terms of healthcare. And another big one is executive oversight of federal agencies. Going forward, it's fair to ask, will we still have a independent Federal Reserve, a independent SEC, FTC, FCC? It all it's all up in the air. Even today, Powell had said that he won't quit before his term, which ends in May of 2026, but it's to be determined, these things. Furthermore, to be determined, some potential beneficiaries of a new administration. Clearly, fossil-based energy will benefit, domestic manufacturing will benefit, and there's a strong sense that many sectors that are highly regulated, like financials or technology, will benefit, whether it's because of less of a focus on regulation and antitrust, but there's just a lot to be determined. And I'll just begin there. I don't have all the answers, but we can begin to frame up the things that we should be focusing on. So now let's take a look back, and we can do this certainly with more certainty. As we look at the year-to-date markets, we've had just a fabulous year. The S&P 500 is up almost 20%. It was up more than 2.5% just the other day. The Dows are up 11%, NASDAQ up 22%, which represents a lot of the leading sectors, technology, communications, and others. But as we'll talk about later in the presentation, the returns really have been concentrated in large domestic mega cap companies. And when we look at the Russell 2000, which is a much broader index, it just reflects that there's not been a broad market participation beyond the mega cap domestic stocks. European stocks continue to lag year to date. They're up just 7.3%. And I think this continues to be a surprise to a lot of market watchers, particularly because we began the year with European stocks, international developed stocks in particular, being just so attractively valued in terms of PE ratios to domestic stocks. There was a sense that there would be kind of an equilibrium that would happen this year, and it's not. China's come back with a vengeance after negative returns for much of the year and then very modest returns with some economic stimulus that's happening there. And if we look at all of the investable opportunities across the world, this MSCI, the All Country World Index, we see the broad market, global markets up nearly 15% year to date. As we've talked about sectors, throughout the year, it's been led by information and communication services. And those are the two that are nearly at the bottom if we look at just the third quarter of 2024. There's clearly a rotation that's happening in the markets. Communication services year to date are up 31%. Technology or information technology is up 29%. But if we just look at the third quarter, they really have dragged behind the broad market sectors. Utilities are leading the way, and it may seem surprising, but it's really being driven by energy demand needs from AI and from falling bond rates. Real estate has rallied in anticipation of falling interest rates. Industrials have had a good third quarter in anticipation of more infrastructure investments, both present and anticipated going forward. So this just gives you a sense of third quarter sector returns. But I think one of the key points here is that there's a rotation happening. And we saw that very clearly in the third quarter of 2024, which will be good for the portfolios, by the way. We can talk about that later. One of the dynamics that we've seen this year, as I've said before, is the concentration of returns. And if you just look at the 7 top returning stocks of the S&P 500, what's known as the Magnificent Seven, which is Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla, they've had the lion's share of the return year to date. And the green graph shows that the return of the Magnificent Seven relative to the S&P 500 in blue, if you just take out the Magnificent Seven and look at the remaining 493, you can see that there's a big delta in terms of the performance. And so as we talk about a rotation, we would expect that there would be a confluence of these as the market's rotating out of these mega cap technology in particular stocks, and that there's a broader based market participation and return, as we've seen happening in the third quarter. In terms of price to earnings, you can see here where price to PE ratios are, right at about 21 times. You can see how that compares historically, going back to 1994. They're elevated for sure, but there may be a strong argument for a growth catalyst happening in the market where elevated PE ratios can be justified. And it's not a difficult argument to make for sure. So we'll see what happens. But as of today, PE ratios on the S&P 500 are at about 21% or 21 times. If we look at yields, interest rates, particularly 10-year Treasury yields, we've moved beyond an inverted Treasury or a yield curve. We've talked about that really for the last 24 to 30 months, an inverted yield curve. It's no longer inverted. It uh, was no longer inverted about 6 weeks ago. And today we see more of a natural upward sloping yield curve. 10-year Treasury yields as of the close of business today were at 235 or 430. They were at 235, and 2-year Treasury yields are at 220. So there's a 15 basis point delta between 2 and 10-year yields, and that's a positive sign. And the yield curve is hanging in there well. So the economy and the Fed. In terms of key drivers for the economy, for some time now, the Fed's been watching 3 key indicators. We've been watching 3 key indicators, and we can check in on them again this evening: inflation, employment, and GDP. And we'll begin with inflation. Inflation continues to moderate. We saw the September inflation report. If you exclude food and energy, it was up 3.3%. With that included, it was down, or it was up just 2.4%. And it continues to move in the right direction. There's a sense of optimism from the Fed that inflation is at present heading in the right direction and within targets. We're finally back to a 2% handle. If you would have asked me a year ago when we were at 9%, 2% just seemed unattainable, but here we are. So that's great news as the Fed thinks about its primary responsibilities of asset price stabilization through inflation, but also they're responsible for a healthy job market. And, the trifecta of a soft landing is to do so by achieving lower inflation, a healthy job market, which means we're adding jobs every month, and continuing economic growth. So as we look at jobs, the October jobs report really came in at a surprisingly low number, down from nearly 250,000. It was up just 12,000 jobs in October. This may be an aberration, we'll see, but it's something certainly to watch. As we try to evaluate the job market, unemployment, of course, is an important part of that as well. And unemployment rates have remained within an acceptable range, that 3 to 4%. If you look at it in a broader aperture, historically, these are historically low rates. It gives us a sense of a healthy job market, but we need to watch job growth in the months ahead. As we think about GDP, we saw a GDP report for the third quarter come in at 2.8% annual adjusted growth, GDP growth. And consensus is that we'll see GDP growth for the year something around 2.75%, and maybe growing from there. So GDP is very respectful and hanging in there. So a lot of the key levers are moving in the right direction. And as a result, the Fed today announced another 25 basis point decrease in the Fed funds rate. It reflects their sense of us making progress and moving forward, being on stable ground, and trying to protect the gains that we do have. So the Fed funds rate is now at 4.75%. And every expectation is that Fed funds rates will continue to fall. We look at the dot plot from the Fed. These are Fed governor estimations of where interest rates will be in the coming months. And it's expected that Fed funds rates will continue to fall. Now, what that means for longer term rates, 10-year and mortgage rates, is to be seen. The 10-year rate has not been as sensitive to short-term or shorter rate decreases. The mortgage rates really haven't fallen along with that either. but we'll see what happens with longer rates. I wouldn't expect to see mortgage rates, that 3 or 4% mortgage rate anytime soon again. So there's a lot of change happening. There's a lot of change on the horizon, that's for sure. But what remains consistent is the foundation's commitment to delivering well-managed, well-allocated model portfolios that continue to deliver on a Methodist alignment in their construction, and portfolios that are fully diversified, that seek and achieve index-based returns, and do so with low costs. So in a world where lots is changing, a commitment to continue to deliver on these core competencies for clients is unwavering and unchanged.